Hello and good morning, everyone. Welcome to the first webinar from GoldenPi. I'm Abhijit Roy, and today I will share my views, thoughts on the topic. Why should you invest in fixed income during these volatile times? Before we get started, there are a couple of things that I would want to call out. So I'll talk on this particular topic for approximately the next 30 minutes, after which we'll have the Q&A session. Now, during this period of discussion, whatever questions you have, you can use the Q&A icon at the bottom of your Zoom panel to post your questions. During the Q&A sessions, I'll pick them up one by one and address them. Also, just to make the session slightly more interesting, there are a few polls inserted here and there, and I think we will see some interesting results out of them. So with that, let's start with the first poll of this session. So I'm going to put on the poll and all of you will be able to see the question. The question is, which of the following fixed income instruments have you invested your money in, right? You have got 60 seconds to take your pick, after which I will share the results. So we have received the inputs from the poll, and here are the results. It's extremely interesting. So maximum number of us here in this discussion have invested, around 80% have invested in fixed deposits. Over 50% have their exposure in public provident fund, whereas the least has been in senior citizen savings scheme. In today's discussion, what we essentially going to cover is what are the directions that we should be taking for our investments during these current times. See, for any investor or any individual, there are three things that an individual would do with respect to his money. One is to earn, second would be to spend, and third would be to save and invest. When it comes to investing, either one would take position in the equity market or would be investing in the debt market, the traditional debt investment option that's there. But in the current times, the equity market is extremely choppy, very volatile. The graph that I have presented before you, the blue line is the volatility index, which is extremely choppy, showing that these are turbulent times in the equity market. But then the other option remains as the bank FDs, which we just saw that over 80% of us have invested in bank fixed deposits. We have to bear in mind that in the current times, the interest rates are as low as 5.4%, whereas 10 to 12 years prior to this, it stood at a healthy 9.5 to 10%. So with this, even bank FD rates are no longer a viable option. When we compare this with the inflation, it's even more complicated scenario. So inflation is the single most factor which clearly depicts how expensive the goods and services that we are availing on our day-to-day life, right, are becoming more and more costlier for us. Just to share an example or a statistic, in the year of 2019, when the inflation rate was anywhere around 3.72%, 1 liter of petrol cost rupees around 79. In 2022, when the inflation rate stands at 6.95%, 1 liter of petrol costs 105 rupees. Now you consider this with all the other things that you're purchasing, right, in your day-to-day life, everything is becoming correspondingly more and more expensive. So it's a very difficult time to be in for people, both who are actively earning, right, as well as the ones who are dependent on passive income, like retired gentlemen, right, retired people. The more question that comes before us is, number one, where do we then invest in such difficult and volatile markets? The answer is certainly fixed income, understandably, because if I put my money in fixed income, the rates of return from my investment are going to be fixed no matter what happens to the market. But then when we look at fixed income, we just saw that bank FD rates are yielding lower than inflation, right? So it's no longer a viable option. There are few other fixed income options also, like a PPF or NSC, but then the rates on them are pretty much on the lower side. It would hover anywhere between 5.4 to 7-ish percentage. Number one, and number two, many of them come with their own inherent uh, constraints. Like PPF would have a minimum lock-in period of 15 years, right? NSC would have certain of its constraints. Then the second question is, do we have an alternate fixed income option which will yield way better than fixed deposits, NSC, PPF, and will help us beat inflation in a very handsome way? Dear friends, of course, there is an option, and that is bonds and debentures. Bonds and debentures are one of those alternate fixed income options which yields way above bank FDs, anywhere between 8 to 12%, right? And they are extremely flexible for investments and freely tradable as well, with no lock-in constraints. So let's then try and understand what are bonds. Essentially, bonds are fixed income securities. And how do they come to the market? So let's say there is a corporation, ABC Private Limited. It wants to increase its business, so it has to raise money. So it borrows money from the market, and in return, it promises fixed interest rate that it will be paying annually till maturity. And at that point, it will return back the money to the lenders. In exchange, it will give the lenders securities which are termed as bonds and debentures. Now, every entity that we have around us, right, in the financial market, ranging from the central government, the state government, public sector units, banks, corporates, all of them use bonds and debentures as one of the most popular routes to raise funds to expand their business and to keep running the operations. Then what is the purpose as an investor, why I should be investing in them? Number one, bonds and debentures are an excellent option to generate regular income from our investment. They pay regular interest, which can be either monthly or quarterly, biannually, or annually. There's one special category of bonds which are termed as tax-free bonds. There, the interest that we earn from them are 100% tax exempted. The third is, because bonds come with a definite maturity period, we can actually time our investments to match our life goals. So let's take an example. Let's say I want to buy a house 3 years from now, for which I'm saving money. I want to invest it, and I want it to mature at the end of 3 years, after which I want to buy my house. I will buy a bond which is giving me good returns of 9 or 10% as per my risk appetite, and I will it's a 3-year duration. At the end of that, the bond matures, I take my money and I invest in my the house that I want to buy. So these are very good options which can be aligned with your life goals. And last but not the least, for any physical asset like land or apartment on sale, the capital gains that we earn are taxable by the government of India. However, if we invest those capital gains in bonds called as 54 EC bonds, then up to 50 lakhs, the entire capital gains are exempted. And on top of that, there is a regular interest income that we earn of 5.75% with a lock-in period of course, 7 years. So let's quickly summarize what would be the benefits of investing in bonds. One is, we clearly understand that since it's a fixed income option, our rate of return from an investment in bond is going to be fixed till maturity. So we are definitely shielded from the choppiness or the volatility of the market. Number two, capital preservation. Why this is important? Because when we consider, let's say, the equity market, at the time of sell, we can either sell at a profit or we can even incur a loss. So our capital, is gone at that point of time. For bonds, given that it is a fixed income option, on maturity, the invested capital is returned back to the investors. Third, like we just discussed, bonds come with annual, biannually, quarterly, or monthly payout options. So it's a steady source of cash flow that one can build to generate a healthy income into one's own earnings. Of course, The rates of returns on bonds and debentures ranges anywhere between 8 to 12% when we consider AAA to A-rated bonds. And that's way above bank FDs. And it is above the current inflation level of 6.95% also. So it serves both the purposes of getting higher yield than bank FDs and beating the market inflation. And since they mature as per their projected timelines, so there's a well-defined maturity schedule which we can build around a bond investments. And last but not the least, it is an excellent way to diversify one's investment options across equity and debt. Here's a quick stat around the returns across the various kinds of fixed income options and bonds. As you can see, bonds offer anywhere between 8 to 12%, which is way higher than the other options which is there. Now, a lot of you might be wondering that then bonds and debentures must be, new age asset class which has come up recently, and this is what we are discussing. That is a myth. Actually, the oldest bond was found in 2400 BC in Mesopotamia, and currently the artifact is stored in one of the museums in America. In India, in the year of 1867, the first set of bonds were launched to raise capital for railways construction. And since then, the central government, state government, public sector units, banks, all have used this facility to raise capital, and which is one of the most popular ways of raising funds for them. Then it becomes important to also understand what is the size of this bond market that we're talking. You'll be surprised to know that bond market is one of the largest fixed income markets in the world. Globally, it is a $128 trillion market. In India itself, the size of the bond market stands at $2.25 trillion. But then till yesteryears, it has been the industries, corporates, HNIs, family offices who have had the privilege of access to bonds and get the benefits out of them. It is now in current times with new technologies and new age companies like GoldenPi that such instruments are now available to investors like you and me for our investment. Now that we have understood what a bond means and what would be the benefits of investing in them, let's move on to understand some of the key basic terminologies around bonds. Face value. This is the basic term that we should understand. And what this means is the price at which 1 unit of a bond was issued by the issuer for the first time. Let's say for our example, it is rupees 10,000 is 1 unit of a bond's price when it is launched in the market for borrowing for the first time. Coupon rate. This is essentially the same as the market FD returns. So coupon rate, we have taken an example of 10%, and it means the percentage of returns that I will get annually from every unit of the bond that I have invested or purchased. So in our example, let's say I have bought a bond at 10,000 and my coupon rate is 10%. It means annually I will be earning 1,000 rupees till the bond matures. Maturity date, call date. They are pretty much synonymous. We won't go into the nitty-gritties of the two. As the name suggests, it means the date by which the bond will mature and the face value of the bond will be returned back to the investors. Now, how do we understand, which bond to invest in and what is the level of risk that the bond carries? One of the quickest indicators for this is credit rating. So there are credit rating agencies, independent companies in the country who actually look at a company, its financials, looks at the bond tranche that the company is issuing to raise money, and then gives a certain rating to that particular bond. And that becomes, a designation for the level of risk that the bond may have. Now, let me put in a caveat over here. Credit rating is a good parameter to consider the riskiness of a bond, but it is not the complete parameter. We need to look way beyond credit rating to understand, the risk of a particular bond. And how does the credit rating work? Essentially, it starts from AAA rated, then AA, A, triple B, B, it goes down. Highest being AAA. And, as we keep going down, the risk level of the bond is perceived to be higher. Yield to maturity is another very important term that we should understand when we are investing and selecting our bonds to invest. Now, when I go to the market, I can buy the bond either at its face value or at a premium price or at a discount price. Based upon that, my returns are going to vary. So if I buy a bond which has got a face value of say 10,000 and I'm buying it at 11,000, annually I'll keep on getting 1,000 rupees from it. So I have paid more for the same cash flow. So my effective returns will be lower. So let's say in this example, if I buy it at 11,000, I will be getting a yield of 9.5%. Similarly, if I would have purchased the bond at a discount of, let's say, 9,500, then that case, my yield to maturity, my effective returns would have been higher, above than, way higher than that of 10%. So yield to maturity, simplistically put, is the effective percentage returns that I'm going to make from my bond investment. Payment frequency, as a term, is self-explanatory. It's a frequency or the rate at which a bond will be paying out its coupons to its investors. In our example, we have considered as a yearly payment frequency. Now let's quickly look at the various types of bonds that would be available in the market. An interesting fact, as of now, there are over 17,000 bond tranches of various rating categories available in the market for investment. Broadly, they can be classified into two distinct types. One, taxable bonds. What does that mean? The interest that we keep earning from them, they will be taxed as per the investor's tax bracket. And the second option are the tax-free bonds. The tax-free bonds are the ones wherein the interest income is completely exempted from taxation. The second important category that we can look at for classification of bonds is based upon the type of issuers. So let's say it is the public sector units and public sector banks like NHAI, REC, State Bank of India, Punjab National Bank, right? They raise money through bonds, and such bonds are rated as or classified as PSU and PSB bonds. The second category are the bonds issued by non-banking financial corporations or NBFCs like Tata Capital, Shriram Transport, so on and so forth. And the third important category are the bonds which are guaranteed by the state government. One such example is the UP Power Corporation bonds, which are guaranteed by the state government, guaranteed for the interest that we pay to the investors and the principal money, which will be returned back to the investors on maturity. Let's look at how does the taxation work on our earnings from investment in bonds. One part of it is the interest income that will keep on earning on an annual basis. It is to be kept in mind that bonds do not come with any TDS option, which is there in bank FDs. It is the liability of the bond investor to declare the earnings from interest during the annual tax filing. And the interest income is taxed as per the investor's tax slab. The other scenario where I can make money in my investment from bonds is if I sell the bonds in the secondary market before it matures. So let's say I sell it at a price higher than at what I had purchased. Then I stand at capital gains. Then because I'm making a capital gains, I'm supposed to pay interest on it to the government. There, for the bonds which are listed on the stock exchange, if I sell the bond within 12 months of my holding, then I'll be liable to pay short-term capital gains taxation. And the rates are as per my income tax layer. However, if I cross beyond 12 months and I do a transaction, I sell it off at a profit, then my capital gains will be taxed at a flat rate of 10%. Then there are unlisted bonds as well, which are not, enrolled or enlisted on the stock exchange. But it essentially doesn't mean that they would be bonds which are risky, not to be considered. One cannot judge in that way because there are a lot of good companies which have raised money through unlisted bonds as well. So it's worth looking at the taxation on them also. So if I hold an unlisted bond and I sell it within 36 months of my purchase, then I'll be liable to pay short-term capital gains, which stands at my income tax slab. And if I sell it beyond 36 months, then it is at a flat of 20% rate. Now let's look at one of the most important things which we as investors should be aware of while investing in bonds. Like any other investment class, bonds to come with their own set of inherent risks. The first risk is the liquidity risk. What does this mean? Given the nature of bonds, majority of the investors hold bonds till maturity, because of which there is not much of trading in the market. That means if I have a bond today, and let's say tomorrow I want to go out in the market and sell it, I might have the risk of not getting a buyer or a suitable price at which I want to sell. This is termed as a liquidity risk. The second risk is that of the default risk. Let's say today I go ahead and invest in the bonds of a company which is not performing well. Then it is highly possible that sometime later, because the company is not running well, it is not able to service this debt. It is not able to pay me interest on time. And then eventually it might not be able to pay my principal also. The company got wounded up, right? It just got closed down. Then I stand to lose my interest as well as my principal. This is termed as a default risk. And third is the interest rate risk. This is a very interesting concept over here. The concept is that in the market, when interest rates go up, price of bonds go down and vice versa. So when interest rates go down, price of bonds would go up. Now, with this fact in mind, let's say I invest in a bond. Let's take our example of 10,000 rupee worth bond I have invested at 10% returns that I'm getting. Now, the interest rate in the economy moved up, which will mean that actually this bond in the secondary market, right, its interest rates will also go up. And so the price of the bond in the market will go down. Now, if I go to sell in the market, I have to sell it at a discounted price, right? This is termed as an interest rate risk. So largely, these are the three categories of risk which we as investors should be aware of. Now, there are means to mitigate those risks effectively. I'll quickly touch upon them. First, for liquidity risk, that is when I go out to the market and I want to sell, I'm not getting a suitable buyer, right? It is always good to invest in investment grade bonds, that is AAA to BBB rated bonds. Best approach would be to remain limited within AAA to A rated bonds because they have maximum liquidity in the market. As you keep going down the credit rating, the liquidity in the market becomes lesser. Number two is a default risk, right? So for default risk mitigation, what investors should do is not only look at the credit rating, invest in bonds which are AAA to A rated, but also look at the financials of the company. For the past 5 years, has a company grown in its revenue? For the past 5 years, has a profit of the company grown significantly, right? Is the company running well? Taking a quick view of such things definitely helps an investor to understand, right, whether there's any default risk in the bond or not. And the third is the interest rate risk. Interest rate risk is very well mitigated if I hold a bond till maturity. Why? Because I buy a bond and I hold it till maturity. Even if the interest rate goes up or down, market goes from north to south, east to west, my rate of returns will remain fixed. I will not be losing out on it. The other way to do it is basically to select bonds which are of short tenure so that if there is a possibility that tomorrow the interest rate will go up in the market, I can actually get my bonds that will mature before this time and reinvest in the market where the interest rates are higher. And so I stand to gain at those times. So these are a couple of ways in which we can mitigate broadly these three categories of risk. Now it's poll time again. So here is the next poll. How many of us are aware of the concept of NCD IPO? You have got 60 seconds to answer. So here are the results. Around 57% of us are not familiar with the concept of NCD IPOs, while 43% are. So for the benefit of all, I'll take a minute to explain what NCD IPOs are and the benefits of them. So what are NCD IPOs? We talked about the concept that companies raise funds from the market to run their operations. One of the methods in which they raise money from the market is in the form of non-convertible debentures that they issue through a public placement, which is termed as the initial public offering of these debentures. So this is like the first time a company is wanting to raise money, it will issue debentures of the denomination of 1,000 rupee each. The minimum amount that an investor then can apply for is 10,000 and then multiples of 1,000 after that. NCD IPOs essentially come with a lot of flexibility. They come with different maturity options of 26 months, 30 months, 60 months, even longer than that, right? And they also have the flexibility of payouts, like you can choose for monthly payout, quarterly, cumulative payment, so on and so forth. So NCD IPOs prove to be a very good option for first-time debt investors who want to invest into the debentures market and invest with as low as 10,000 ticket size. Currently, there are two IPOs which are running in the market. One is that of Navi Finance. This is an NBFC company, which is started by ex-Flipkart founder Sachin Bansal. And the other one is that of Muthoot Finance, which was started in 1939, one of the oldest gold loan companies. With that, we come to the end of this discussion from my side. Now I will pick up the questions which you have raised and I'll answer them one by one. Okay, so here we have a question from Mr. Pankaj Kikani, and his question is, why only you are recommending bond investment in volatile times and not generally too? Well, we selected this time because it is all the more pertinent, more so from the perspective of equity investors, because a lot of volatility is there. So where do they park the money? They can start looking at fixed income. But otherwise also, it is always a good option to park your money for fixed return into bonds and debentures. And there is no specific good time or bad time for that. All times are okay for it. The second question that we have is from Mr. Muthayan. And the question is, global interest rates are at an all-time low. Is it secured to invest now? Of course, it is a good time to invest now because with interest rates being low, bond interest rates are above that of the market interest rates. So you would be earning more. Now, if you're asking the question that tomorrow, if the interest rate starts creeping up, then how do we mitigate that? One approach there can be to invest in very short-term bonds of short duration so that, when the market starts picking up with interest rates, these bonds mature and you can plow back your money in the current set of bonds at that point of time at a higher interest rates. Next question we have from Rahina. And the question is, what happens on the call date? So this is what I had skipped during the discussion, trying to avoid the entry cases. So it's now a good opportunity to explain what a call date is. A call date is a date on which the bond issuer decides whether to call up the bond and say that, okay, the bond has matured and return back the money or not, right? So if let's say it's a bank and it has issued bonds with call dates, on the call date, the bank will decide whether to mature of the bonds and pay back the investors or not. This is how the call date works. The next question is from Mr. Ravi Verma. The question is around his investment. It says, I have invested in APCRDA bonds through GoldenPi. I want to further invest around 1 crore in bonds, but the premium of bonds is still very high on your platform. Would like to invest in safe bonds floated by state government SDL. Well, this is a question specific to GoldenPi. So yes, definitely you can invest in SDLs also through the GoldenPi platform. You can get in touch with your relationship manager for your investment needs. There's a very interesting question on a very different perspective from Mr. Subramaniam Kumaran. And he asks, why are very few bonds allowed for investment by NRIs only? What is the rationale behind this by the government? It's a very tricky question to be answered, honestly. So there are certain norms laid by RBI, which says that the debt that a company is shouldering should be within certain percentage only of investors from outside. Now, that again comes with the constraint of there are only certain sectors of bonds wherein foreign investors can invest. Why? Because with foreign investment in a particular company, investors sort of get a control on that. So let's say I have got a very critical company, a government company, wherein majority of the investors are from outside. Now, tomorrow, if they sell off, what happens to this critical institution that's there, right? So to have a check and balance around this, the government of India has laid certain rules by virtue of which there are certain bonds only in which NRIs can invest. We have the next question from Mr. Subramaniam Kumaran. It says, is interest earned on government bonds like REC against LTCG is tax exempt? So we have to look at, interest earned from government bonds like REC. Right? So there are two varieties of bonds that REC would have in the market. One is a taxable bond and the other one would be a tax-free bond. For the taxable bond and the tax-free bond, when it comes to the interest earning, taxable bonds definitely will be subject to interest taxation. Tax-free bonds will be exempt. But LTCG is the concept when I want to sell off their bond before maturity in the market and I make a capital gain. In that case, both the bonds will be subject to LTCG. There is no exemption on that. Our next question is from Mr. Gururaj Rao. He has asked, PPF and NSC are not for NRIs. Can you suggest some good fixed income schemes for NRIs? Well, I will restrict my discussion to bonds and debentures only over here. So what I can say is there definitely are a group of debentures from banks which are and from the state government guaranteed bonds wherein NRIs can invest and can get good returns. MK has asked a question. Please also discuss about the risks in bonds and debentures. We did cover it, but I will probably lay it out quickly once again for the benefit of this question. Three risks to be considered in investing in bonds and debentures. One is the liquidity risk, which is if I hold a bond and I need my money tomorrow before maturity, if I have to go out in the market, will I be able to sell it? That is liquidity risk. The second risk is the default risk, which means I have invested in a bad company. Now the company is not being able to service its debt, so it's not paying me interest. And probably after some time, it winds up. It's not able to run its operations. So I lose my interest as well as my principal. That's the default risk. And the third one is the interest rate risk, which means that I'm holding a bond at a certain, price. Tomorrow, if the interest in the economy goes up, the price of my bonds will go down. So I'll be sitting at a sort of a notional loss. Next question is from Mr. Mutayan. And he says, some of the bonds are not listed in GoldenPi. If we want to buy that bond, how could we do it? Why GoldenPi is not listing all bonds? So the reason why GoldenPi platform does not list all bonds is there is a bit of a due diligence which happens before a bond gets listed. One is bonds have to be within the credit rating of AAA to A. The moment there is any one or more ratings of that bond that goes below A rating, it is removed from the platform. Number two is a bit of a background check on the companies is also done. Is there a financial distress news in other company? Is the management performing well? Any negative news around it? If there are, then the GoldenPi platform with withhold publishing those bonds onto the platform. The next question is from Mr. Sachin, and he asks how to select the bonds for a longer run. This is a very interesting question because if you want to have a bond portfolio on the long run, one strategy that is used is termed as bond laddering. What does bond laddering mean? It essentially means you buy multiple bonds with multiple periods of maturity. So let's say I have some amount of money. I put in some bonds which will mature at the end of 1 year. I'll put in some money which will mature at the end of 2 years, some money which will mature at the end of 3 years, 5 years, 10 years. I will do a staggered kind of investment across multiple bonds. That way is, I'm able to get the benefit of interest across the horizon. Whether the interest rate goes up, goes down, I'm able to mitigate that very well. This is one of the most efficient ways which are used by investment bankers to structure the fixed income portfolio of investors. And the concept is called as bond laddering. The next question is from Mr. Ranjan Ghosh, and he asks, how can NRIs invest in bonds? What are the KYC requirements? Does GoldenPi support NRI KYC? So the answer is yes, GoldenPi definitely supports NRI KYCs, and NRIs can come to the platform, can select the filter which is around the left-hand side on the Discover Bonds page, which says that NRI investable bonds. There you will get a list of bonds wherein NRIs can invest their money in. And to know what are the KYC requirements for NRIs, you can look up the FAQ section or the dedicated blogs which are there, which states out what are the various documents required for the KYC completion of NRIs. A very subjective question from Mr. Arjit Shukla, and he asks that, would it make sense to exit current positions in equity at very low profits and invest lump sum in bonds? It's very difficult for me to be able to give a stance and advice over here. But if I would have been in this position where my equity is at a very low profits, probably I wouldn't exit. I would do that. I mean, this is not an advice to anybody. I wouldn't actually exit. Probably, I would invest any further investment that I would have into bonds and debentures so that even if the equity market falls further, my bonds will give me some propping. We have the next question from Mr. Swagatika Pradhan. And the question is, how to save capital gains? Best way to save capital gains is to invest the capital gains into 54 EC bonds. There are bonds issued by NHI and REC, wherein up to 50 lakh, you can deploy your capital gains and be completely exempted from taxation on the capital gain that you have done. We next have a bit of a theoretical question from Mr. Aniket. And the question is, what is the difference between bonds and NCDs? Simplistically put, a bond and debenture both are debt securities. But bonds are issued mostly by public sector units and government entities and the government. They normally come with a sort of a collateral. NCDs are non-convertible debentures. They're compulsorily issued only by corporates. They can be securitized by collateral or may not be. We have another question from Mr. Ranjan Ghosh, and the question is, also let us know the taxation around bonds in India. We covered that topic, but I'll quickly hash upon the topic once again. So there are two components to taxation. First is the interest income. If you're investing in a taxable bond, it is going to be taxed as per your income tax slab. If you're investing in a tax-free bond, zero taxation on it. But one point to be noted over here is that tax-free bonds work well for investors who are in the 41% and above interest taxation category. The other thing is on capital gains that I might make on a bond if I sell it in the secondary market. So if it is a listed bond and I sell it within 12 months, I will be liable for income tax as per my tax slab level. And if I sell it beyond 12 months, it will be at 10%. If it is an unlisted bonds, the period for STCG is 36 months, again taxable at my income tax slab. And if it is beyond 36 months, the LTCG will be at flat 20%. Chandrasekhar N. He has asked a question, minimum investment amount. When the minimum investment amount starts from 10,000, you can participate in NCDs, IPOs, and you can invest as low as 10,000 in bonds. We have a question from Mr. Rakshit, and he asks, does GoldenPi provides facility to trade in bonds? Well, GoldenPi is an online marketplace for both buy and sell of bonds. If somebody wants to sell bonds, not trading per se, somebody wants to sell bonds, one can always raise a sell request and get the sell done of his bonds on the platform. Mr. Charan asks a taxation question. Is TDS applicable on maturity of bonds? If yes, what are the slabs? So the TDS concept is not there in the case of bonds. It is the responsibility of the bondholder to lay out in his income tax filing what is the interest income that the person has done from his bond investments. So there are no TDS on bonds. Mr. Charan has asked one more question. Can you cite an extreme case where bonds were written off? Very good question. Or what are the risks associated with bonds? Well, one of the examples which immediately comes to my mind of an extreme case where bonds were written off was that of from the Yes Bank. So this was in the year of 2020 when Yes Bank went into a default and all its tier one bonds were called off. So yes, there have been cases where bonds have been written off completely. And what are the risks associated with bond? I think we have covered that before also. And then quite a few repetitive questions. Interest rate. Okay, there's again one more question from Mr. Subramaniam Kumaran, and he asks, interest rate risk is not relevant if one waits until the bond maturity. Please confirm my understanding. Yeah, that is true. That if I invest in a bond at 9% returns, right, and tomorrow, let's say the interest rate went up, if I go to sell in the market that bond, I have to sell it at a cheaper price because the price and the market interest rates are inversely related. But then if I don't do that, if I abstain from that and I hold it till maturity, I will continue to gain my 9%. There is not going to be, any kind of change in my returns on the bond. It's going to be fixed. A very interesting perspective from Mr. Harish Pawar, and he's mentioned, I'm expecting real insight about bonds. All the information being shared is basic and can be easily read and understood on GoldenPi website. Share knowledge that's beyond GoldenPi website interface. That's a great question. So this is the first webinar that we are holding, and I really wanted to keep it very generic and informative for the first time bond investors. But rest assured that we will hold webinars in sequence after this continually with more and more insights into how to invest in bonds, how to select bonds, right? More applicable information and key insights into what are the parameters that should be considered while making your selections. So yes, we'll be having those sessions shortly. So just stay tuned. So I'll take the last question. The last question is, this is from Mr. Pankaj Rathod, and he says, can we transact in primary market leveraging GoldenPi? Well, if I've understood the question correctly, your question is, can you participate in the primary market through the GoldenPi platform? Well, the primary market has got two modes of investment. One is the NCD IPO, and the other one, which we will talk in the next sessions. So in NCD IPOs, if you're looking to invest, definitely you can go to the GoldenPi platform and you can make your investment in the NCD IPOs. We are now running out of time. So this is where I will pause now. And we'll move on to the last poll of the day. It's been a wonderful set of questions, happy to share more answer. Rather, what we would do is we will try and address some of those questions which I couldn't cover now over email to investors properly. Collate them together for everybody's benefit, and we'll share them so that everybody's queries are answered. So here we have the last poll of the day, and which is, what is the next topic that you would be interested to hear about in the next webinar? All right. So we have got the responses. Thank you very much for your response. We'll come up with the next webinar shortly. So thank you everybody for participating in this webinar. I hope I have been able to share something valuable or something useful for your fixed income investments. Until next time, thank you everybody.